Hey everybody, happy Friday to you. Time for Condors, Calendars, and Butterflies. My name is Brent Moores, and this week I want to talk a little bit about earnings. The earnings season is here. It started earlier this week, and it's going to be going on strong for the next few weeks. So let's kind of talk about how your trades may take advantage of earnings or be aware of earnings. We'll talk about that in just a minute. But before I go too far, let me just mention I have James Boyd in the chat helping me out today. I appreciate James. Make sure you check out his Investing Master series on, I can't remember when that is exactly, but that is, why am I not remembering that? That's Tuesdays, I think, Investing Master series. Yes, Tuesdays, 11 o'clock Eastern Time. James Boyd. You can also follow either of us on X, formerly known as Twitter, at Brent Moores CS, at James Boyd CS. Now, as we go into this, remember, options do carry a high level of risk and are not suitable for all investors. And the material today is intended for general informational purposes only. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And the paper money software application is provided for educational purposes only. We'll be looking at that today, but paper money does not assign short options early. So just realize that, but that's different than your real account. Rolling strategies can entail additional transaction costs, and all investing involves risk, including loss of principal. There's no guarantee of an execution. A stop order will be at or near the stop price. And past performance is no guarantee of future results. I'm not going to factor in commissions into the trades we look at, but keep in mind commissions are a real thing and they can affect the outcome and should be considered. All right? Okay. Well, hey, thanks for joining me, everybody. Let me head on over to the Thinkorswim platform. This is the S&P 500. Mostly flat today, we'll say. But the trend has been strong, and I have a 20-day moving average on the chart. That's in red, and a 50-day as well. But the 20-day, you can see we bounced off that nicely, and a lot of traders may be more bullish. But that's a general trend. And within the general trend, we go up and down. And if there's going to be a lot of companies coming out with earnings. And so when we're looking at this is, for most technical traders, looking at this trend is telling us, maybe giving us more of an idea of what the stock may do over a longer period of time, a month or more. But when earnings comes out, often we're looking at just a move up or down, and the trend doesn't really tell us what earnings is going to do. If you have a stock that's trending up like the S&P 500 right here, you probably wouldn't bank on it being a positive earnings result that the stock's going to go up. You may think it's going to move a lot, you may think it's going to move a little, but it's kind of hard to get an idea of direction on that stock there. Okay, so just keep that in mind here. Now, with earnings, and we have a full earnings calendar coming up. Here's just some major stocks coming up next week. Today, by the way, is the 16th. So we've got Netflix, Halliburton, and so on down the list. And then out a couple weeks, we have Meta, Microsoft, Tesla, and so on. But on each of these companies, when we look at them, it's very likely, in fact, let's just pull up Netflix, because we said that in NFLX, that's coming up with earnings. When we look at this and say we look at we'll go a 1-year chart and look at implied volatilities, what happens is, when you have earnings, very often you see that implied volatility drop. Earnings, implied volatility drop. We haven't had earnings yet, but there's probably an expectation of a lot of traders and probably a reasonable odds that we're going to see an IV drop in that. Now, this one was a little weird because the market was kind of going crazy right at this point. So IV spiked right there and actually started to come down a little bit before earnings. But even then after earnings, you can see it dropped a little bit there. So we can factor that in the trades and the types of trades that we do. If we want, we can do trades that we can call a negative vega trade. That is an option trade where a drop in implied volatility would tend to help out the trade. However, that can go too far sometimes. We can get so focused on that. Let's look at a stock like Halliburton, for example. Here's Halliburton. It's coming out with earnings on the 21st, which is next Wednesday. Keep in mind, we have a holiday weekend this weekend. Martin Luther King Day is Monday, so markets are closed. So really just a couple days of trading before we have earnings on this. But let's do this. Let's look. I'm going to go out a week, so past earnings here. And I'm going to just go to Theo Price, Mark. Let me just look here at this. And the stock's about $32.50. So I'm going to look at the 32. We're just going to go at the money on this. And what the Theo Price does, it can kind of give us an estimation of what the option price will be. And that's all it is an estimation of what the option price will be given certain parameters. And those parameters can be a move in the underlying stock. It could be a move in a change in implied volatility. And that's what I'm going to focus on right now. And of course, the change in time. But what we're looking at is between now and next Friday, so a little bit beyond next earnings, it's about $1.69. So I'm going to say about $1.50 move. Let's say we just did a long call on Halliburton here. Long call on Halliburton at the money strike. And I go here, let me just reset this. And I say the stock is going to go up $1.50. Stock goes up $1.50. And we're going to say implied volatilities drop. Well, before I do that, how much implied volatility? Right now, IV for the month is about 46. And, you can see later IVs, things will drop. Let's say we have about a 7-point drop in implied volatility. I don't know if that's what it's going to be, but that's probably not a terrible estimate there. It's going to be a drop. So I'm going to put a minus sign here. Okay, now let's look at this trade. At the money, initial price, 81 cents, follow up the expected price, the theoretical price, about $1.76. We've doubled our money, or even a little more than that, perhaps, on the long call. Now, a long call is not a negative Vega trade. A long call is a positive Vega trade. In other words, the drop in implied volatility, that 7% drop in implied volatility I just estimated here, is factored in. That's hurting the trade a little bit. But the stock, we're counting on the stock going up. And so when we're talking about what is going to affect the trade most in terms of option Greeks, say, and we're going to think of our main option Greeks of delta for the price of the stock, okay? We're going to think about theta for the time decay of the stock, and vega for the implied volatility effects of the stock. Usually, delta is going to be the biggest factor. In fact, sometimes it's overwhelmingly the biggest factor there. So I guess my point is this. We can factor in Vega, and we're going to factor in Vega. We're going to look at some stocks that are negative Vega trades today. However, you don't have to kill yourself to do a negative Vega trade in front of earnings. Because yes, implied volatilities may be higher, and it may get worse when earnings comes out. But number one, it's probably not going to be the biggest factor in determining whether you make money or not. Probably the direction is going to be the biggest factor. And number two, there's a reason implied volatilities are high right now before earnings. And that is there's more potential move in that stock. Okay, so if you have any questions on that, let me know. But let's go and just kind of do a standard implied volatility, a standard earnings trade factoring in implied volatility. I'm going to look at FCX here. Okay, so here's FCX. Okay, so here we go. Again, stock's been going up, trading up. I'm not going to worry about the trend. I'm just, because here's why. when I'm looking at this, and on FCX, we have earnings on the 22nd. That's next Thursday. Well, we're almost done with today's trading. Anything can happen the rest of the day, but we're almost done with today's trading. Monday's a holiday. So really, we only have 2 full days, Tuesday, Wednesday, and I don't know if this is morning Thursday or afternoon Thursday, but there's only maybe 3 bars here in this. And we're in the middle of a little bit of a pullback here, but the trend's going up. So I'm not going to worry about the overall trend here. I'm just going to try and anticipate, is this going to move a lot or a little? Well, what's the expected move on FCX? Here's FCX. Let me just get rid of that. And in fact, what I'm going to do is I'm going to go to, we'll just go to Delta. Okay. Expected move. About, we'll say $3.50. It's just under $3.50. So if I look at this chart, that $3.50 move, it's a plus or minus. So 3.5, 58.50 minus 3.5 is going to be about 55. Let me just put a little line here right around 55. Okay. And so, and Chris said it's before market open on Thursday. Okay. And $3.50 move added to 58.50 is going to be, let's see, 59, 62. Okay. So that's about the range. If I think the stock is going to stay, say, within the range, okay, this is kind of what the market's saying by next expiration. If I think, it may move a lot because, hey, earnings comes about, but that range seems one that I think it's likely to continue in, then maybe I do a trade that is going to be a trade that anticipates a smaller move. And and there's different ones that we could do that are negative vega trades. For example, we could do an iron condor. Okay. Iron condor would be one. We could do, say, for example, butterfly. Okay. Those are both negative vega trades. Now, we could do something also like a calendar spread, but that actually is not a negative vega trade. That's actually a positive vega trade. So I'm not going to look at that right now. But there you go. So, and we could also do things that aren't, a short put vertical is a negative trade if we do it out of the money. Short call vertical, negative trade if we do it out of the money. But let's start with an iron condor here, and we'll look at some different variations of trades today here. So what I'm going to do here is I'm going to go and I'm going to go to the trade tab. I'm going to go to, I'm on FCX. I'm going to go up past expiration here. Now, some of you may be looking and go, well, that market maker move is a 20-cent move. What's up? Because our implied volatility is highest for this option that's going to expire in 2 hours, it is giving that market maker move, but that's for basically today. So we're going to look at this one right here. That's where I got that $3.50 move on there. But if I'm going to do an iron condor, I'm going to sell a call spread and I'm going to sell a put spread. So on the call spread, we said the stock was going to be around, we wanted it to be within the $62 level. Remember, $3.50 plus our 58.50. So I'm going to go to that $62 level. I'm just going to click on the bid price. Okay. I'm going to go a strike above 63, and I'm going to do a control click on the ask price. That's a call vertical. I'm going to do the same thing on the put side, except what we said was we were going to go to the 55 strike. I'm going to sell this. I'm going to hold down my control key, and I'm going to buy the 54. Okay. That's an iron condor right there. Let me just analyze this trade here for a second. We can take a look at it and move down. And that's what your iron condor looks like right now. Let me go to here and just look. Where's our break evens? Well, break evens are, well, let me set my slices to break even here. Set slices, break even, 20. I think I have the right date, 24th. Does that put it? Yeah, 24th. Okay. So it's a higher probability trade. If it moves a lot, we stand to lose more than we potentially win on this trade. This is a higher probability trade, but the cost of the higher probability trade is our reward to risk isn't so hot here on this, right? That's just how iron condors work. Now, so there we go. Now, question in the chat. This is from John. It's a good question. How soon before earnings do we put this trade on? So ideally, you put it on. Well, put it this way. This trade is intended for earnings. We can put it on any time before earnings. On too far before earnings, there's probably a decent chance that implied volatilities will just go up, and then earnings will come down and come out, and they'll drop at that point. There's no point. This part, the rising implied volatility portion of that trade doesn't help us that much. However, there's also more time for bigger, different movements in the stock. It becomes less of just an earnings play. Okay. It becomes less of an earnings play, and more, if we go way out in front of the trade, and more of just a general trade on FCX. So in this case, we're doing it a few days beforehand, and I think that's fine. That's no problem. We'll look at an example later where we do a trade, which are maybe a couple weeks ahead of time. That's fine too, but there's just a little extra uncertainty in there. So usually these earnings trades doing just a few days before the trade. Could you do it the day before? Yes, you could actually do it the day before. So when I look at this trade though, we have, let me just set a slice to the current price right here. Here's our current price. There's our vega, our negative vega on this trade. We have some time decay, theta there, and it's not completely delta neutral, but realize if the stock starts to go up, our delta will then switch negative, or if the stock starts to go down, our delta will then switch more positive. But right now, it's a smaller amount here on that trade for our delta there. So that's the trade. Now, how much is that delta vega going to affect things? Probably not that much, to be honest. It's 31 cents there on this. In terms of the trade, it's certainly in terms of, well, sorry, that's 31 cents on that, not that. 82 cents, okay? 82 cents. So right now, that certainly can affect things, but if the stock moves a lot, it's going to affect us a lot more. What if we are looking at this, though, and we're saying, you know, I don't like this. This is a trade that it's a higher probability trade, but I think this stock is going to move more. Or I think that this reward to risk just isn't worth it. You know what you can do? You can always just flip it around and do a long iron condor. I call this a short iron. This is a short iron condor. Usually I just say iron condor. Usually most people just say iron condor. Technically it's a short iron condor. But what we could do if we wanted to is we could flip this around and realize this is not a super high price stock and there's just one contract. And but if I switch this around, look at what the trade looks like. It's just the flip. It's just the reverse. Where's the reward to risk now? Now our potential reward is much higher, okay, than our potential risk. Okay? So if you're ever looking at these and going, well, you know what, it just doesn't make sense, the reward to risk, given the percentages. Here, the percentages are, what is that, 65% or somewhere in that ballpark. of us losing money in this case, but the reward is much, much better. Now, if we do a long iron condor, what happens to our vega, our implied volatility spot? So that's going to be working against us. Our time decay is going to be working against us. But if we get the big move, that would be a reasonable trade there. Okay, that would be a reasonable trade. So, in fact, let's do it. Let's go. Now, if you have it right, let's see. I'm on the trade tab. If I want, I could just right click on this if I wanted to flip it around and just create an opposite order, and it should just flip it around for me. There we go. Now that's a debit trade. Okay, so that's the trade. That's the reverse trade that's this trade right here if we want. Okay, now let's go and let's send the trade. Okay, let's send the trade. So I'm going to confirm and send. Now, there's 4 legs here. Okay, there's 4 legs. Getting filled at a mid price is probably unrealistic, to be very honest. I'd rather not pay the full natural price. So I'm going to go, we'll kind of split the difference there. And I'm going to confirm and send. And I'm going to put this in the iron condor bucket. This is a long iron condor, though. This is expecting a larger than expected move in the, our trade is banking on a larger than expected move for actually, you know what, I'm going to do more than one contract though. Let me just go here. We'll do 4 contracts. Confirm and send. And let's put that in. Okay. All right, there we go. So there are other trades we can do. In fact, let's do this, okay? So can we cover Meta in the context of it? Yeah, we can talk about Meta. That's no problem. Let's go back to that earnings calendar because we have Meta coming up on the 28th. By the way, that's the same day as Microsoft and Tesla. So some of the big hitters are coming out next week here in terms of earnings. But let's take a look at Meta. Now, I was not planning on doing a trade on Meta because I already have a trade on Meta going on right now. Okay, we already have a trade on Meta, and usually just for clarity, I don't duplicate different trades here. All right, so let's go to Meta. Now, here's Meta. We've got earnings. Okay, earnings coming up. And so we have a little bit more time here on this. Let's look at implied volatilities. Let's see what happens on this. And these are things that you may look at before earnings. Here's our IV. Here's the drop that we saw in IV. Okay, not as much of a drop in IV this time. A little bit of a drop in IV. And what we'll see here, I don't know what we're going to see. If you're interested in looking at past earnings on this, one thing you can always do is you can go to the Analyze tab, the earnings page. I'm trying to remember, I don't think this is available on Paper Money, but it is available on your live platform here, okay? So we've got Meta. We can see what happens to IVs historically over earnings here. Here's our implied volatility, and the kind of reddish, orangish line here, I guess that's more reddish. You can see what happens to implied volatility here. This would be an average implied volatility going from 48% down to about 31% right after, okay? Implied volatility, this is Q1 24, from about 54% up to down to 37%. Okay, and you can do that for each of these. I'm not going to go through each of these, but you can go. It doesn't have to be this stock. You can look at whatever stock you want. That's what happened. You can see what's happened to implied volatility on that. What's this yellow line? Well, the yellow line, it should say that's historic volatility, I think. Let me just, it doesn't, I don't know why that's not, it's like cut off here. So that's historical volatility. Well, implied volatility is an expectation of the future. We're expecting here big movement in the stock. And then earnings comes out, it moves, and then the uncertainty of earnings has passed, and there's a lesser expectation for big moves in implied volatility. Does that make sense? Because there's less uncertainty after earnings have dropped. But historical volatility is looking at the past of what the stock has actually done. Before earnings, stock isn't moving as much. Once earnings comes out, boom, all of a sudden, you have big movements in the historical volatility, in what were happening, in what has actually happened. So that's why these two are going opposite directions on that. You can also see this is kind of getting at the same thing in a different way, I guess. The at-the-money straddle price. Now, we talk about a variety of different trades here, and one kind of standard type trade that people may consider before earnings is a long straddle or a short straddle. I'm not going to cover those because we have a whole webcast dedicated to straddles. Okay, that's on Mondays at 11 o'clock Eastern time. So I'm going to reserve that for that webcast. I'm going to reserve that for that webcast, but just realize this straddle is a way of pricing expectation of movement. Okay, the price of the at the money straddle is, you know when I went back here and I said, well, our movement may be up or down $2.8 or up or down $17 or something like that. You could look at the at the money straddle. So let's do this real quick. I'm not going to do a trade on that straddle. Let's see, stock's at 623. We'll call this about $16, that at the money straddle price. $17 here, about the same, right? So that's how some people, if like you're stuck, I love the Thinkorswim desktop platform, but if you're stuck without this on here and you can find an at the money straddle, that's another way of anticipating, kind of expecting what the market is saying the move is priced to be. Okay. Now, one other thing on this page while we're here. So these are kind of looking at volatility moves, expectation of moves. Here's what the stock actually did. Of course, you can see that on the graph itself, the stock graph itself, but gives you a little snippet of it. But this tells us what the earnings were, okay? Actual in yellow. Look at the key, because the colors may be different on your page. And the estimates in green. Yeah, we're beating estimates, beating estimates, beating estimates, beating estimates, beating estimates, and a significant fail of estimates, significant miss there. Just because you beat estimates doesn't mean the stock goes up, though. See if we can see some examples of that. Look, we beat estimates. What did the stock do? The stock went down. Most of these others, the stock kind of cooperated, but just because we beat on the bottom line doesn't mean the stock is going to go up. A lot of times it comes down to things like just guidance as to what's going to come out. Okay, so those are some things you can look at when you're looking at this trade. If you expect, we could do the same trade we just did here. If you want. Now, I don't want to do, you can do short iron condor, long iron condor, short iron condor, Vega, negative Vega, probably beneficial in the case of a earnings play, but or long iron condor if you think it's going to move a lot. Another common type trade that is a negative Vega trade is a butterfly spread. We can do a butterfly. Here's Tesla. Tesla's coming out with earnings the same day as Meta. So I'm looking at Tesla because, number one, we already have a trade on Meta. And I thought this may be a decent one to consider. And you can see we have earnings in 2 weeks or so, something like that. Okay, earnings on the 28th. What's today? Today's the 16th. So not quite 2 weeks, but almost there. So let's do it. How do we do? Well, what's our move? What's our expected move on Tesla? Let's go out past earnings. We said earnings was the 28th, so I'm going to go to the 30th of January. And I'm looking at about a $35 move. You see where I'm getting that? About a $35 move. Let's do the same thing and do our math here. Okay, so I'm just going to say this is 440 plus $35 is going to be 475, which is going to be right about here. Okay. 440 minus $35 is going to be about 405, which is going to be right about here. Something like that. That's the range there that we're looking at. 475, 405. Let me just jot those down real quick. Okay. And we're right around 440 right now. So let me get out of this. Let me go back to the trade page. I'm going to go out past expiration. And in this case, I'm going to do a butterfly. I can just switch this right up here to butterfly. And I can go to 440. Now, it's going to spread these out incredibly tight. Okay, $2.50. Well, that's not how I'm going to do it, but let's just get it in the order template here. And I did it wrong. I clicked on the bid price. I meant to click on the ask price. There we go. There's our butterfly. Okay, this is a long butterfly. Let's change this to 405. And what did we say? 475. Make sure we're unlocked there. So this is a standard butterfly. Now, we'll look at it here. And then, but you know what we can do? We can flip this around. This is how we normally do butterflies. Let me analyze the trade and go to risk profile. Let me move this over. Okay. And we said it's January 30th. That works. And let's set, looks like our slices are set pretty much. Let me just make sure those are on to break even. There we go. And lower probability trade to start. And that's standard. 90% of the time when you just pull up a butterfly spread, you're going to see it's a lower probability trade. By lower probability, I'm just going with break-even points here on this. Now, you can look at it and say, well, look, we potentially can gain more than we can lose on this. I mean, that's above a $2,000 gain. It's just a little bit below a $2,000 loss. But keep in mind, that can be kind of a tough target to hit, right? That's kind of the bullseye. Odds are, even if the trade goes well, we're not going to get to that. We're probably not going to wait for it to get to max gain either. On a butterfly like this, very often, if we've made a third of what we can potentially make on this, we'll look to exit the trade. Okay, that's just management on this. Further management would be, hey, this is supposed to be more of a neutral trade. If it turns super bullish or bearish, we're likely to get out. But keep in mind, this is based on earnings. This is just kind of an earnings trade. Our implied volatility is going to be negative on this. Implied volatility is helping us out on that trade. And we can certainly do that trade if we want. So, but as I mentioned, what if you don't like the trade? Well, you can flip it around, can't you? Yeah, you could flip this around. Let's do this. Let me go. There's the flipped short butterfly spread. So this is, these aren't standard trades. I don't do many short butterflies in this webcast. If you are interested, by the way, I just got through a whole series in this class on different types of trades. Okay? 12-week series. We're out of that series now. But if you want to go back to that series and review some of those trades, well, I'll put a playlist for this webcast in the chat. If you're watching on a recording right now, that's great. You can't see the chat, but that's all right because I put it in the description. The playlist for this webcast is in the description of this webcast here too. Okay. You may have to click on, I think it says show more or something like that to expand the description to see it. But you can see standard butterflies, standard iron condors. Here we're kind of going out a little bit and changing it a little bit more. Here's my point. It's just the opposite trade. What was a loss before becomes a gain. What was a gain before would be a loss. Okay? You don't have to do on this trade. Think of other trades. Think about a short put vertical. You flip that around. What's flipping a short put vertical around? It's a long put vertical, right? The contract that you were going to sell becomes the contract you buy, and the contract you buy would be the one that you sell. Okay? So there we go. Now this is kind of let's think about this trade. What's our max loss on this trade? You can see this right here. So we don't have like naked calls here. This is just two spread trades, right? This is a long call vertical and a short call vertical put together, crammed together right there. Okay, that's all that is. So increase your vision. You can be a little creative on these trades. Just be aware whenever you're doing trades, maybe it's a trade you haven't done before, be aware of what your max gain is. Be aware of what your max loss is. Be aware of what your break even is. And one thing I would say, and also probably what your probabilities are on these. I mean, you may have a theoretical max gain or max loss of something, but realistically, are you going to hit any of those? Think about it from the probability standpoint there. So you can be creative a little bit in your options trading, but just be aware of that, trade. Now, I'm not going to do this flipped over butterfly here. I'm going to go with our standard butterfly spread on this. This is a trade where we expect the stock to stay where? Well, let me go back here. Let me flip this one back around here. Between 416, we'll say 415, 465, something like that. Okay. So that's the premise here. You can tweak this a little bit. We can go, instead of 405, we can go to 400 and 480. What's going to happen? If we spread these wider, what happens is the probability's getting better, higher probability, but our reward to risk is going to look worse. Okay, on that. All right, let me go back here. I'm going to just stick with this one as is, and I'm going to confirm and send. And we're going to put this in our butterflies category. We're going to buy this trade, and hasn't filled, but we'll see. We could always push that a little bit. Cancel replace order. We'll try that again. Cancel replace order. And we'll go, right, let's try that. See if that fills. There we go. Okay, we filled on that. Now, I don't want to restart this right now. Okay. It is not letting me. Okay, I have an error on my Thinkorswim right now, and we're getting close on time, so I'm not going to go through the process of restarting it, but let me just get some questions here while we do this and talk about some other things. Last week in this webcast, we talked about collars in order to protect a position. If you are interested in seeing that webcast, you can go to last week's. I already did the playlist thing, right? What I did in my managing an options portfolio class this week was we took off a couple of those callers. Why? Because we had earnings. And the uncertain event, that is earnings, that we wanted to protect ourselves with had passed. Earnings happened to turn out fine on those stocks. One was Delta Airlines, one was CNP, okay? And so the callers actually worked against us in a sense, in that the caller portion that we closed out of, and I don't think this is going to let me, it's not going to let me move here, but otherwise I would show you, I took off those trades, okay? If you want some explanation of that, you can certainly go to my Managing Options Portfolio webcast. I just put that link in the chat. And it's also in the description. Okay, it's also in the description. But the ones that were done specifically for earnings are no longer there. Actually, CNP wasn't for earnings, so we still have that caller in there. Bank of America was another another caller we did that we exited because of earnings. So we exited Delta, we exited not Bank of America, Bank of New York Mellon, BK. We exited those. CNP we're holding on to for that reason. Now, what about management? Okay. Can you put a stop on these? Yes, you can put a stop on these. Both the Iron Condor, if you wanted to, you could do a stop. The Butterfly, you could, if you wanted to, you could do a stop. That's no problem. Typically, though, especially with an Iron Condor, you have two vertical spreads for your Iron Condor. Manage those separately, okay? And getting out of four legs of a trade, whether it's a Butterfly or Iron Condor, can be difficult. But one thing that we're going to use, management rules we're going to use both for Butterflies and Iron Condors, is once we get close to expiration, we're typically just going to get out of the trade. Okay, I'm not talking earnings trades here. Anytime we're doing Iron Condor or Butterfly, typically if we're about a week to go till expiration, we're just going to exit that trade. In this specialized case, where we're doing this based on earnings, once the earnings event is over, in which we're doing the trade, usually we're just going to look to get out because earnings have passed on that. Okay? And yeah, sorry, I wish this wasn't stuck on me right now. So that's one reason you would get out. Another reason you would get out, if it breaks down, these are either trades in the case of a long Iron Condor, a trade where we're expecting a big movement on earnings. Well, because of earnings, we're just going to get out no matter what. But if we're expecting a big movement on a trade and it's obvious it's not going anywhere, then we're probably just going to get out of the trade. Similarly, on the Butterfly, which we don't want much of a move, but it starts to trend strongly, probably going to get out of those trades. Okay. Furthermore, in the case of the Butterfly, when are we going to get out? If you've made a third of what you can make, certainly by a half of what you can make, you're probably going to be looking to exit using the rules that we trade in this class. Obviously, there's a lot of different rules that you can use, but that's what we're doing in this class. Okay, now, if you want more on management of these various trades, every week on Wednesdays, Managing Your Options Portfolio, it's at noon, or you can go back and watch. It's recorded as well, so you can really watch whenever you want. We talk about Butterflies and short verticals and Iron Condors and long calls and long puts, whatever type of trade. We mix it up, Managing Your Options Portfolio. All right, everybody, thanks for joining me today. Thank you, James, in the chat. Sorry about my little Thinkorswim issue I had at the end. Normally, I would just restart it. By the time I restarted it, we were going to be about out of time anyway. So have a great rest of the day. Coming up next, we've got market and sector analysis. So have a wonderful holiday weekend, everybody, and we'll see you all same time next week. Bye-bye, everybody.